Hello, ladies and gentlemen. I hope you are fine wherever you are. I am the Acca tutor, your number one Acca tutor online. My name is Jerem Timkulu, and those are my credentials as you can see on the screen. You can get in touch with me anytime, 24/7, at +263 774 596 368, or you can simply email me at jeremtimkulu at gmail.com. Okay, I am from Transcal Business School, and our website is www.transcalconsulting.co.zw, as we are proudly a Zimbabwean company. Okay, so far we have been, traveling well in this accountant's journey, and you guys have been dealing with financial statements of individual companies. In this particular video, we are going to look at a situation when a company invests in another company. Okay, that's the essence of group accounting. So we are going to first look at the statement of financial position for the group. That's the main focus of this video. So I hope by the end of the video, you guys would have benefited in the knowledge of this group accounting. Specifically, you should be able to define and describe uh, the following in the context of group accounting. Okay, you should be able to define and describe a parent, what a parent company is, a subsidiary, control, consolidated or group financial statements, non-controlling interest, trade or simple investment. You should also be able to describe the components of and prepare a consolidated statement of financial position or extracts thereof, including the following adjustments: fair values, intra-group trading, unrealized profits, acquisitions partway through the year. And lastly, you should be able to calculate goodwill using the full goodwill method. For those who are studying the Acca paper FA, these objectives are just as enough for you, because the other complex issues are for those doing advanced papers. So let's get straight to the business of the day. Now, what is a group? A group exists where one entity, the parent, referred to as the investor, has control over another entity, the subsidiary, also referred to as the investee. Okay, remember, we are talking of groups not for the purpose of for group dynamics, as in HR, human resource management, or in organizational behavior. No, we are talking of groups in the sense of commerce, in the sense of accounting. Okay, so a group exists where one entity, the parent, referred to as the investor, has control over another entity, the subsidiary, also referred to as the investee. In accordance with IFRS 10, consolidated financial statement specifies 3 criteria that should be observed for one to establish whether control exists or not. Number 1, power over the investee. There should be power over the investee, which is normally exercised through the majority of voting rights. Okay, that is owning more than 50% of the equity shares that automatically makes you the parent. Okay, I mean that automatically shows that you've got the power over the investee. When we are talking of power, ladies and gentlemen, we are referring to those rights to direct, okay, to direct relevant activities. So if you have got those rights to direct relevant activities, then we can simply say, we can be convinced that you have got the power. But for us to say you have control over another company, we need also to look at the remaining two criteria. There should be exposure or rights to variable returns from involvement. For example, some form of dividend. Are you going to get some dividend? Are you also going to suffer some losses? So should be some exposure or rights to variable returns. Variable returns simply mean that your gain from this particular investment is not going to be fixed. Okay, if it is only fixed, then you do not have enough control, my friend, because when the company makes huge profits, you're not going to get the extra profits. You're only going to get the stipulated profit, so you do not have control. But if you have got control, then when the company makes huge profits, you're going to get the benefits. But when it also uh, enters into some losses, you're also going to suffer the pain. Okay, so if you are such an individual who has got exposure to variable gains and or losses, then we can say that you have control. Then the ability to use the power. Do you have the ability to use the power over the investee to affect the amount of investor returns? Do you have the power to say, we need 20% return, we need 50% return? Do you have that power? If you do, then you have got control over the investee. Okay. There are those other definitions which are also important. A parent company is a company that controls the other company. A subsidiary company is the company that is controlled by the parent company. Consolidated accounts are those accounts for the whole group, where we treat the group as though it is one big company. Okay, so when we consolidate, we are simply saying that all these companies should be reported as just one single entity. Does own 100% of the subsidiary, then the part owned by others is known as the non-controlling interest. Usually, originally it was minority interest. Okay, so the minority are referred to non-controlling interest. Okay, and remember our guiding standards are IFRS 3 and IFRS 10. Okay, IFRS 3, that's business combinations, and IFRS 10, that's consolidated financial statements. You should read around those accounting standards for you to get a deeper understanding of this subject area. Then we have got an animal called a trade investment or a simple investment. A trade investment is one in which the investor is neither a subsidiary, in which the investment, rather, this is a typo, in which the investment is neither a subsidiary or an associate. Okay, it is not a subsidiary or an associate. It is accounted for as a financial asset. Please take care. Take notice. It is accounted for as a financial asset and normally measured at fair value at each reporting date. So, in other words, trade investments are accounted for using the dictates of IFRS 9, financial instruments. Financial instruments. Okay, we'll know this as we advance with our studies. But at this level, we are not much required to know into detail about the IFRS 9 standard. Okay, um, the purpose of consolidated statement of financial position is to show all the assets and liabilities that are controlled by the parent, effectively as though it is one big company. So, let us just go through the following together. We have got this example, Paradza. On 1 January 2008, Paradza P acquired 100% of the ordinary shares of Shadia S, which was incorporated on that date. On 31st December 2010, the statements of financial position of each of the two companies were as follows. We've got the non-current assets, which were 25,000 for P and 12,000 for S. Investment in asset cost was 10,000. Okay. Um, Current assets 8,000, 9,000. Share capital 25,000. That one was 10,000. Okay. And retained earnings 15,000, 8,000. Current liabilities 3,000, 3,000. You are required to prepare a consolidated statement of financial position at 31st December 2010 for the P group. Okay, for the Paradza group. So, how are you going to go about that? Remember, we want to prepare a statement that only shows one entity. Okay, so we are going to merge the two companies into one entity, okay, in our reporting. So we are going to have something like this one. Okay, you can see that the group statement of financial position is only showing one entity. Okay, we are only showing these figures, a single column. Okay, we are no longer showing the positions of the two. So the idea here is we have consolidated. Why? Because we are going to do a line by line amalgamation. Okay, we are going to add line by line. All right, although the issue of the investment, as you can see here, we've got the investment. Now, in the group statement of financial position, we are no longer going to have this line of investment in S, because we would have accounted for in terms of the dictates of IFRS 3, okay, business combination. All right, and the investment has been we are only going to consider the issue to do with the goodwill. Okay, all right, we are only going to consider the issue to do with the goodwill. So instead of having the line for investment, we are only going to have a line of goodwill. Okay, or for goodwill if we had goodwill. Okay, but unfortunately in this particular example, the net as remember, the formula for goodwill is equal to consideration transferred. Okay, consideration transferred plus NCI at acquisition less net assets at acquisition. Okay, so in this case, all right, the consideration transferred, all right, was 10,000, as you can see here. Okay, as you can see there, the 10,000 was transferred. However, the subsidiary had a net assets of 10,000. Okay, because it was acquired on the date of incorporation. Okay, this subsidiary was acquired on the date of incorporation, which means the net assets were the same as the share capital of the subsidiary. So in that case, the consideration transferred was 10,000. Okay, and NCI was 0 because we acquired 100%. So the NCI was 0. So 10,000 plus 0 is equal to 10,000 less the net assets of 10,000. Obviously, we're going to have 0 goodwill. So this is why we are having a situation where we are only going to account for non-current assets, which were 25,000 plus 12,000. The 25,000 is this one, and the 12,000 is that one. Okay, then we are not going to take this because we said in group statement of financial position, this entry is not going to be found because we are merging. All right, so there's no point in actually having a separate line for the subsidiary investment. So if there was goodwill, then we're supposed to have put the goodwill there. But in this case, as the goodwill is 0, therefore we have to ignore the goodwill line and proceed to the current assets. The current assets are 8,000 plus 9,000, and this is why you are seeing 8,000 plus 9,000, and we get 17,000. The non-current assets were 25 plus 12, and we get 37. And then we go to the share capital. The share capital that is only going to appear is for the parent. Okay, it is for the parent, and this is the share capital we are talking about. We are going to ignore the share capital for the subsidiary. Okay, so in the group statement of financial position, only the share capital of the parent. If there was some share premium, only the share premium of the parent was going to be considered. Then when it comes to retained earnings, we are going to take the retained earnings for the parent as well as the retained earnings for the subsidiary, as you can see here, this one and that one. Okay, the current liabilities, we are going to take them again both. Okay, that is 3,000 plus 3,000. Here this is 3,000 plus 3,000, and we get 6,000. All right, so that's a snapshot of what we are required to do. Okay, but normally what happens is that companies purchase other companies after they hear of their trading power. It is very rare for a company to buy another company on the date of that other company's incorporation. Okay, that one is very rare. Normally, people or businesses purchase other businesses when they hear of their trading performance history. Okay, so that they are able to come up or to justify the reason why they purchased those companies. So in those situations, we have things like pre-acquisition profits and post-acquisition profits. So we are going to that area straight away. Please just hang on as we try to navigate those territories with an example. Okay, but before we do an example, I think we need to be at the same level when it comes to the mathematics of consolidation. uh, there are certain things which we need to observe, or there are certain workings which we need to appreciate, so that our journey, in as much as or in as far as consolidation is concerned, is going to be superb. So there is this particular working we call the first working essential. Whenever you are confronted with a consolidation question, you need to have this work working structure, so that you navigate the question with easy. All right, so the first thing, when you are confronted with a consolidation question, you have to um, know the group structure. So you need to outline the group structure. For example, if a parent, or if a company purchased 80% in in another company, 80% of of shares in another company, then automatically a subsidiary has been acquired. Okay, a subsidiary has been acquired, and the group structure would be uh, a situation where we've got P is the parent, okay, which purchased uh, 80% in S, okay, 80% in S. All right, so in this case, automatically our NCI, the non-controlling interest, or the minority shareholding is 20%. So on your workings, the first workings, you should have to establish the uh, the group structure, okay, and then you need to do working number two, which talks of the net assets of the subsidiary. Okay, you need to know the net assets at acquisition as well as at reporting date. Net assets at acquisition and at reporting date. This is essential, as you will see with our computations, that if you do not know the net assets at reporting date, you are likely to fail some of the workings. Okay, remember I indicated that there are certain workings which apply at acquisition, and then workings which apply post acquisition, as we take into consideration things like retained earnings pre acquisition and post acquisition, as well as at acquisition. So the total of issued share capital and share premium from the subsidiary statement of financial position should be unchanged at both the date of acquisition and the reporting date. So you will discover that the share premium and share capital figures are going to be unchanged. All right. And one thing you need to understand is net assets include the share capital or share premium plus any revaluation reserve and retained earnings. Okay, this constitutes the net assets at acquisition. Okay, so please watch out there. Also, some other fair value, okay, fair values of certain assets which could have not been included when the subsidiary was being acquired. Okay, you need to be aware of such information of those items. Okay, now goodwill. Remember I said that in this group statement of financial position, usually we are going to see the goodwill figure there. Okay, we are likely to see the goodwill figure in the non-current assets part, under the physical non-current assets. You are going to see the goodwill there. Okay, um, okay, it's in a line that is within the non-current assets. Okay, there are the first ones, we are likely to see the physical non-current assets like land and buildings. Okay, then we are likely to see the goodwill line. Okay, we know that goodwill is an intangible asset. Okay, it is an intangible asset, but it is a non-current asset, so we are likely to see the goodwill in the group statement of financial position. Okay, and one thing, the reason why I said we are likely to see the goodwill there is because at acquisition we are likely to have this double entry where we say we debit the we are likely to see this entry, okay, where we say that if we have goodwill, if we have goodwill at acquisition, then we are going to debit goodwill and credit bank, okay, for the consideration transferred. Remember, there's a consideration that we would have it transferred. Okay, okay, consideration transferred. Okay, although this entry is likely to be different when we have a negative goodwill. Okay, if we end up having a negative goodwill, we are not likely we are likely to modify this double entry. Do not worry, we'll talk about that. All right, so this is the working, ladies and gentlemen, for goodwill, where we say that it is calculated by taking into consideration the fair value of consideration paid, okay, the amount which we paid to the owners of the subsidiary, and the fair value of the non-controlling interest at acquisition, less the fair value of net assets at acquisition. And the net assets were determined in working number 2. This is the working number 2. As you can see, the net assets of subsidiary would have. So this is the figure we are going to use for the net assets at acquisition. Okay, this is the figure we are going to use to slot here. And then we get the goodwill. So if this figure is positive, then this entry applies. Okay, if the figure is positive, then that entry applies. The double entry applies. Then we move on to working number 4, where that is non-controlling interest. All right, we do these computations. The fair value of non-controlling interest at acquisition, which is working number 3. Okay, the working number 3. Okay, this is the value we are talking about. Okay, fair value of non-controlling interest at acquisition. So we would have done this, but the figure should actually be the same. All right, the figure from working number 2 is likely, working number 3 is likely to be the same as the figure in working number 4 for fair value of NCI at acquisition. Then we add the NCI of post-acquisition reserves. The NCI of post-acquisition reserves. And this is found in working number 2. And this is why I said you need to know the net assets at acquisition as well as at reporting date. So the net assets post acquisition reserves would be, the share would be the difference between these reserves and those reserves. So the reserves at acquisition versus the reserves at reporting date. So any difference, we then have to subject it to the NCI percentage. If it is in this case 20%, we are going to say 20% multiplied by the difference here. Multiply by the difference. And we get the NCI share. Okay, that's the NCI share. So you can see that your workings should be structured such that you're not going to be found wanting. Okay, and then you get your NCI. All right, this NCI is going to be found, or to be a line for NCI is going to be found under the equities in the statement of financial position, under the equity. Okay, when we deal with the parent equities, we then have to move to the non-controlling interest equities. So this is an equity element, or an equity item for the non-controlling interest. Then lastly, we have to look at the group retained earnings. Okay, the group retained earnings, you appreciate as well that it is almost like the NCI working, although there are some differences here and there. Here we are looking at the parent's retained earnings. We take the parent's retained earnings. Okay, the parent's retained earnings. This one, this figure there. All right, and this is the retained earnings of the parent at acquisition. Okay, the retained okay okay this is the parent's retained earnings, that is 100% of the parent's retained earnings at a reporting, sorry, not acquisition but reporting date, at reporting date. Okay, and then we have to include the parent's share of the subsidiary's post acquisition retained earnings, and we this is in working number 2. Okay, because we said we for the NCI we consider the 20% difference. However, for the parent we consider the 80% difference multiplied by the difference, and this is retained earnings. Okay, and this was NCI. Okay, that is working number, this was working number 4, this is working number 5. So please watch out for this, just watch out for that. So these are our workings typically. So let us go through this particular example to see if we can put this knowledge into effect. Okay, H owns all of the shares issued by S, and therefore there is no non-controlling interest to account for. Okay, the statement of financial position of H and S as at 31st December 2028 were as follows. Okay, we have got the non-current assets, that is property, plant and equipment 85,000. Okay, let me try to find a darker pen. Then we have got shares in S 60,000, current assets 160,000, 84,000, and then we've got equities. Okay, we've got equity shares, share capital, the nominal values, and then the share premium, those ones, and then retained earnings. Okay, current liabilities, and then we are told H acquired 100% holding in S on 1 January 2028. At that date, S retained earnings were $15,000. All right. So we are required to prepare the consolidated statement of financial position for the H group as at 31st December 2028. Okay. As our norm, we need to establish the group structure. Okay. So working number 1. Now let me look for a much brighter pen. Okay, working 1, group structure. Group structure. Okay, the group structure, we are told in the question that we had purchased 100%. Okay, 100%. So we are having our H here, which purchased S 100%. So obviously the NCI is equal to 0. Okay, then we have to go to working number 2 on net assets. Okay, for the net assets, okay, so working 2, okay, net assets. Now, for the net assets, I indicated that you need to have figures for at acquisition, at reporting. So we start with the share capital, okay, and from our question here, um, the share capital for this subsidiary and share premium are given there. All right. So 20,000 and 10,000. Those are the figures we need. 20,000 share premium, 10,000, and these figures are not supposed to change. Okay, so just have to take them as they are. Okay, but the other elements of the net assets, we've got the retained earnings. Okay, these ones now you need to take the retained earnings at acquisition, and from the question we are told the retained earnings at acquisition were 15,000. Okay, they were 15,000, so you just have to pick that figure. Retained earnings 15,000. Okay, what about at reporting? At reporting now, you just have to go to the balance sheet of the subsidiary to see what was there. At reporting, the subsidiary had 25,000 at reporting, or that is at the 31st of December 20x8, it had 25,000. Okay, so let us add the figures up. Here we are having about 45,000. Here we have about 55,000. So you can see, I mean, the difference here in terms of the post acquisition reserves is actually going to be is emanating from the retained earnings, and there is a 10,000 post acquisition difference. Okay, now when you do that, you then have to go to move to working number 3. Okay, working number 3, let us just this one now, we said this should be for the goodwill working. Okay, that's the fair value. Goodwill is the fair value of consideration transferred, and we transferred how much according to the question. We transferred 60,000. Okay, we transferred 60,000, and the fair value of NCI at acquisition. Okay, the fair value of NCI at acquisition. Sometimes if you do your group structure very well, you can easily see that there is NCI or not. As you can see, our NCI is 0 because we purchased 100% of the shareholding. So the NCI is 0, okay, and we get 60,000. Then less net assets at acquisition. The net assets at acquisition 45,000. So our goodwill is going to be 15,000. So goodwill is 15,000. As you can see there, okay, that's our goodwill. Then let's move on to working number 4. Okay, let me add another paper. Okay, working number 4. This is now for the NCI, the non-controlling interest. Okay, the non-controlling interest is going to be, according to our formula, if you still remember, we need the fair value of NCI at acquisition, fair value of NCI at acquisition, and we said this is in working 2, if you still remember. Okay, I mean it's in working 3. Okay, let us go back. Okay, the fair value is in working 3. All right, because this is where we highlighted that it should be in working 3 there. All right. I mean here. All right. So we indicated that it is found in working 3. Okay. Now we determine that the fair value of NCI at acquisition was 0. Okay, because we purchased 100%, so NCI is 0. Even the post acquisition elements are also 0. Okay, I'm sure we are together there because there wasn't NCI initially, so it is not going to come out of the blues. Okay, out of the blue. So in that case, our NCI is going to be 0. Okay, NCI share of post acquisition. I'm just writing here so that you in future examples where there are NCI elements, you're not going to be found wanting. So NCI share of post acquisition reserves. Sorry. Um, so NCI is 0. Okay, let us move on to the next working. The next working should be working number 5. Okay, this is retained earnings. The retained earnings, ladies and gentlemen, we're going to have the retained earnings of the parent. Okay, are retained earnings of the parent at reporting date. At reporting dates. Okay, we are led by the question. If we visit the question, we are likely to be led properly. Okay, if we visit the question, we are likely to be led properly. Okay, this is our question. So you can see that here the retained earnings of the parent are 70,000. What's happening with my pen? 70,000. Okay, so we're going to take that figure, the whole of that figure, 70,000. Then the parent's share of sub post acquisition retained earnings. Okay, the post-acquisition retained earnings. Remember, the share of the parent is 100% because they bought the total of 100%. So that's 100% multiplied by the difference. The difference, remember, is emanating from the net assets. That's working number 2. Okay, the working number 2. We said the difference was 10,000, which was emanating from the retained earnings only in this case. So that's 25,000 minus 15,000. Okay, 25,000 minus 15,000, which is 10,000, as you have seen there. All right, so we are going to take the 100% of this difference, and that's 10,000. Okay, so you can see there are no other adjustments to our retained earnings as per this question. As you can see, nothing. We are not told of any intra-group sales and so forth. So we are home and dry. We can proceed safely with our computations to see if we can come up with an applicable statement of financial position. So here, if we add up, we are going to get 80,000. Okay, so those are our retained earnings for the group. Okay, then we need to come up with the statement of financial position. These were just the workings. Okay, now after you do your workings, you can safely draw up the statement of financial position for the group. Okay, so we are going to start. Remember, don't forget to put the heading, because if you do not put the heading indicating that this is a group, you are going to annoy the examiners. So group statement of financial position. Group statement of financial position as at 31st December 20x8. Okay, then we start with the assets. Okay, you start with the assets, and our assets are in the form of non-current assets. The non-current assets, according to the question should lead us in that area. Okay, the non-current assets, we've got PPE 85,000 plus 18,000. Remember, this is a line by line consolidation. Okay, so PPE 85 plus 18. PPE 85,000 plus 18,000. Okay, let me use my calculator here to see if we can come up with something. That's 103,000. Then we have got Goodwill, which we did in working number 3. Our Goodwill, if you still remember, the Goodwill was how much? The Goodwill was 15,000. Here it's 15,000. And I think for the non-current assets, we are done. So we add up those ones, and we should get our 118. So these should be our non-current assets. Then we add up the current assets. The current assets from the question, these were just written as current assets. Okay, if you can still remembering correctly, yes, that's 160 plus 84. Let me punch the figure in my calculator to see if I am doing it correct. Should be 244,000. Okay, if we add them up, we must get our final figure for the assets, and it should be 362. So we've done, we've done the first part of the statement of financial position for the group. Let us now go to the equities and liabilities side. Okay. Okay. Now we can safely proceed to the equities and liabilities section. Liabilities. Okay, and our equity shares, $1 each. Like I said, we take off the parent only. We take off the parent. Okay, so from the question, sorry, I'm taking you back a bit. Okay, this is our question. That's 65 and the share premium 35. Okay, those are the figures we are going to check. 65 and 35. So that's 65,000 and share premium 35,000. Okay, and we then have to put in the group retained earnings. This is working number 5, and our working number 5 is showing 80,000. Showing 8,000 for the retained earnings. Okay, once we do that, we then have to add up, and we should get how much? 65 plus 35 plus 80, that's 180. Okay, and then we proceed to the non-controlling interest. If we had any, we should have put it here. Okay, but unfortunately, according to working number 4, there was 0. Then we go to the liabilities section. Okay, liabilities. And from the question, do we have any liabilities? We only have current liabilities. Okay, 135 plus 47,000. All right. Current liabilities. And we are saying these are as given there. Okay, 135,000 plus 47,000. And if we add with our calculators properly, we should get 182. This calculator of mine, 182,000. Okay, if we add that figure to 180, we should come to 362,000. And as you can see, our equities and liabilities total is equal to the assets total here of 362, which means we have done our balance sheet properly. Okay, the group statement of financial position is balancing. We have done our workings correctly and our balance sheet, our statement of financial position properly. Okay, now let's move to a bit more complex ground. Some examples we've just ignored them because they are self-explanatory and they are for the benefits of our former students, so that they just get the solutions direct to their labs. Okay, now we've got Pico, which acquired 60% of the shares in S on 1 January 2007 when the retained earnings of S stood at 6,000. The fair value of the non-controlling interest at the date of acquisition was 30,000. On 31st December 2010, the statement of financial position of each of the two companies were as follows. So we can see, we can see that these are the balance sheets of the two companies. Okay, we've got P, we've got S. Okay, and the investment in S was acquired at a consideration of 40,000. Okay, and we are told that it was a 60% acquisition, therefore S is a subsidiary. Okay, and you can as well suspect that there could be some goodwill somewhere. If you look at the net assets at reporting. Okay, you can see the share capital is 20, the retained earnings 16. Okay, but even if you look at the share capital, you can see that it's a bit lower than the acquisition, the consideration. So you on that basis, you can as well suspect that there should be some need for computation of goodwill. Okay, now when this company was acquired, there were also retained earnings on that date of 6,000. So there is need to consider some pre-acquisition gains, okay, in our computations. So let's follow the normal workings. Okay, working number 1, that is the group structure. Working number 2, the net assets. Working number 3, the goodwill. Working number 4, NCI or non-controlling interest. Working number 5, retained earnings. Remember, these workings could be expanded further as more items come into play, but for now those are the standard minimum workings. You should show your examiner that you have read and understood the syllabus. Okay, so without wasting much of your time, let us go straight to working number 1, which is the group structure. Okay, the group structure, that is working number 1. That's a W, ladies and gentlemen. Forget my writing. Okay, this is the group structure. Okay, so we are told that this P acquired 60% in S, 60% acquisition. Okay, and the NCI obviously is going to be 40%. Okay, then let's talk of the net assets. Working number 2, net assets. We have got at acquisition, at the pen. Okay, I'm going to have a problem with my board here. Sorry for that. So I just have to, squish these things to fit in a small place. Okay, it's reporting. So we've got two figures that should appear. Okay, so we start with the share capital. According to the question, our question, sorry. Okay, what's going on? All right, sorry. Uh, the share capital is 20,000 of the subsidiary, so we are going to pick that one. Okay, so that's 20,000, and we guess it is going to remain the same at reporting. And then the retained earnings. The retained earnings at acquisition, we were told, ladies and gentlemen, and we were told that these were 6,000, okay, from the first line, okay, the first sentence there. When Pico acquired this subsidiary, the retained earnings stood at 6,000. Okay, so those ones were part of the net assets of this subsidiary. Okay, so we have to consider them. So retained earnings at acquisition. At acquisition, 6,000. However, this could have changed after the acquisition because we are told that the retained earnings were now 16,000. Okay, they were now 16,000 by 31st December 2010. They were now 16,000. So we can safely say 16,000. Okay, and I guess there are no reserves and other reserves and so forth. So we can safely close our net assets and total them up. That's 26,000. That's 36,000. And the movement, as you can see there, is within the retained earnings from 6,000 to 16,000. Okay, so the difference is the post acquisition movement. Now, we need also to determine the working for goodwill. So we need to compute the goodwill, and we can call that working number 3. Working 3, goodwill. Okay, so it's fair value of consideration. Fair value of consideration. And from the question, we can easily see that the consideration was 40,000. Okay, and the value of NCI. Remember, goodwill is fair value of consideration plus fair value of NCI at acquisition. Fair value of NCI at acquisition usually is given in the question. In this case, in this question, the fair value of non-controlling interest was 30,000. Sorry, my pen sometimes problematic, but I'm sure you can see that it was 30,000 there. So we're going to say 30,000, and then less net assets, and we said net assets at acquisition, that's working number 2, which was 26,000. Okay. So obviously the 70,000 minus 26,000, we get, obviously we're going to get 44,000. 44,000. This is going to be our goodwill at acquisition. Goodwill at acquisition. Okay, that was our working number 3. Now let's try to squeeze working number 4 here for the NCI. Working 4. The NCI, this should be our working number 4. Okay, and like I said, we start with the NCI at acquisition, so that's fair value of NCI at acquisition. Remember, this NCI should be valued at fair value. Almost everything should be valued at fair value in terms of IFRS 3 business combinations. So you need to watch out for that. Okay, the values should be fair values. Okay, and the definition of fair value is determined in IFRS 13 fair value. So what was the fair value of NCI at acquisition? This is given in the question, which was 30,000. Okay, in the question, the fair value of NCI at acquisition was 30,000. Just reread the question. And the fair value of NCI post acquisition. Okay, the NCI share of post acquisition retained earnings, and I said it is the difference. The NCI here, we said it is a 40% NCI, so that's 40% multiplied by that difference, multiplied by the difference between retained earnings at acquisition and retained earnings post acquisition, and this is the difference we are talking about. Okay, and you can see that it is 10,000. So 40% multiplied by 10,000, and we are talking of 4,000. Okay, and we then have to add up these two figures, and we get 34,000 as our NCI, current NCI to date. Okay, then we move on to working number 5, which is retained earnings of the group retained earnings. And here I said you start with the parent retained earnings at reporting. Okay, and these ones can be found in the question. The retained earnings of the parent is 44,000 currently. 44,000, so you slot in that figure. And then the parent's share of post acquisition retained earnings. And remember, this is a 60% subsidiary, so the group has got an entitlement to the 60% shareholding. So 60% multiplied by the difference, and the difference we discovered it to be 10,000. So we put our 6,000, and we have to get our retained earnings should be 50,000. Okay, from the facts in the question, you can see that we've done the majority of the workings that are required. So some of the workings now is like those line by line consolidations can be done within the balance sheet itself for the purpose of the examination. So let us now do the balance sheet. We start with the non-current assets, then current assets, then move on to the equities and liabilities, and so forth. So the Group SFP as as at 31st December 2010. So we start with the assets, with the non-current assets. Okay, the question should lead us non-current assets, that's 50 plus 30. 50,000 plus 30,000, we get our 80,000. We then have to go to the current liabilities, but before then we have to consider goodwill. Okay, this is why I said the double entry. At that time I say that you recognize goodwill, you debit goodwill and credit the bank. Okay, that's at acquisition. So that's how the goodwill was recognized at acquisition. However, this is at reporting. So the goodwill figure, we calculated it in working number 3, and we determined that the goodwill was how much from the workings. The working number 3 is this one. So this is our working number 3. So it's 44,000. 44,000. Then we have to consider the current assets. We do the line by line consolidation. So we are talking of 14,000 plus 12,000. 14,000 plus 12,000. And this should give us 26,000. Let me cross check with my calculator. Now sometimes these figures might confuse. Yes, that's 620. That's 26,000. So if we add these figures up, we should get 80 plus 44 plus 26. That's 150,000. We then have to get to the equities and liabilities. Equities and liabilities. We start with the share capital. Okay, share capital. Here we take off the parent only, the parent share capital, which is this one, 50,000. 50,000. And then we move on to the retained earnings. There was no share premium. Retained earnings, and this is the working number 5. According to our working number 5, the retained earnings were 50,000. Okay, the retained earnings were 50,000. Then we need to add this up, and we get our 100,000. We then have to add NCI, which was working number 4. The working number 4 NCI is telling us 34,000 NCI. So that's 34,000. Then we go to the liabilities, the current liabilities. The question only has got current liabilities. As you can see there, we have got 10,000 and 6,000. So 10 plus 6. That's 16,000. So you can see that if we add them up, we get our 150,000, which is equal. So it means that our statement of financial position for the group has balanced, and we've done our computations correctly. Okay, let's move on to other areas in the same subject area. Okay, we need to know how to compute the purchase consideration which has been transferred. Okay, sometimes it is straightforward. It will be, we will be told that the group or the parent transferred cash, okay, the actual cash. So if it is in the form of cash, then the computation is not going to be uh, tedious or complex for us. But when it involves things like a share for share exchange, then in that case we need to be very, very vigilant. Okay. The calculation of goodwill must be based on the fair value of the consideration transferred. For cash, this is straightforward. It is simply the amount of cash paid. But what about for shares? Here we have to consider the fair value of shares. That is the market value of the shares of the parent, okay, on the date of the acquisition. All right, that's what we have to do. Okay, suppose Pico acquired a subsidiary, ESCO, for, I mean, by issuing five of its own share, that is five of the parent's share, of the parent's shares, for every $4. I mean, for every share, 4 shares of the subsidiary. So we need to consider the market price of the parent's shares. So at this date, the market price or the market value of Pico's shares was $6. So the fair value of the net assets of ESCO at that date was 75,000. The fair value of the consideration transferred can be computed as, we know that the total number of shares in the subsidiary was 12,000. Okay, but we are only going to transfer 5 for every 4. Okay, so that's 5 for every 4 multiplied by 12,000. Okay, multiply by the parent's share price, which was $6 at that date. So this is why you are seeing that you end up paying 90,000 in monetary terms. Okay, so basically we would have considered the share for share exchange proportion. That is, we are going to transfer 5 for every 4. That's 5 over 4, multiplied by the total number of shares in the subsidiary, multiplied by the market price of the parent's shares at the date of acquisition. Okay, so we are going to debit as an investment in the subsidiary of 90,000. Okay, and then we are going to credit the share capital. Okay, we're going to credit the share capital of the share capital and the share premium. Okay, remember the shares in the parent were worth $1 nominal. Okay, so in this the $6 market price comprises of the $1 nominal, nominal share price, and the remainder, which is $5. 1 plus 5, that's 6. $5 share premium. So when we acquire shares, we are issuing shares. When we are issuing shares, we are crediting shares. We are crediting share capital, okay, which comprises of the nominal price and the share premium. So this is why we are crediting. In this case, as you can see there, let me try to. As you can see, we are crediting the share capital. Okay, we are crediting 12,000 multiplied by 5 over 4 multiplied by $1. Okay, multiplied by $1 nominal, and we get 15. And then here we then, for the share premium, that's 12,000 multiplied by 5 over 4 multiplied by $5, as indicated there. This is 75,000. Okay, so the goodwill on acquisition would be based on the 90,000 investment. As you can see, that's the fair value transferred of 90,000 less net assets, as we are told that the net assets were 75,000, and we get our goodwill there. Okay, think that is that. Okay, I hear somebody might be wondering, what about the fair value of NCI? Remember, in this particular example, we have acquired all the shares, in this particular subsidiary through a share for share exchange. So there is no NCI to worry about. Okay, there's no NCI to worry about in this regard. Okay, what about a situation where we are involved with intra-group trading? Okay, P and S may well trade within each. With each leading to the following potential issues to be dealt with. We might be having some receivables and payables in P and S that effectively cancel each other out. Okay, dividend paid by the subsidiary recognized as income by the parent. Similarly, if a dividend is paid by one entity and received by another, the net effect of this to the group is zero. Okay, unrealized profits on sales of inventory between parent and subsidiary. So that you can understand this concept, consider um, the following question: can you make a profit if your right hand sells goods to your left hand? Obviously not. And the same reason, and for the same reason, a group cannot make profit when one part of the group sells goods to another part. Now, current account. If P and S trade with each other, this will probably be done on credit, leading to a receivable, a current account in one end statement of financial position, and a payable, which is also a current account in the other and its statement of financial position. This amount should not be consolidated because the group would end up with a receivable to itself and a payable to itself. Receivables and payables would consequently be overstated in the group statement of financial position. These balances are therefore cancelled or contract against each other on consolidation. So if you still remember the issues to do with transfer pricing and so forth, those ones are cancelled. They do not have impact on the group's profit. Okay, I think we would try to make this point known with an example. However, uh, to deal with problems of unrealized profits, we do the following: calculate the unrealized profit in inventory, reduce the inventory, and reduce the retained earnings of the company that has sold the goods by the amount of the unrealized profit. It is unrealized because it was profit made within the same group, not from transactions with outside partners. So that profit wasn't actually profit at all. Okay, now let us have a go at this one. Common P has a controlling interest in S. Extracts from the statement of financial position of each company individually as at 31st December 2010 as follows: receivables 50,000, 30,000, payable 35,000, 40,000. Included in P's receivables is 8,000 owing from S. Okay, S payables include the 8,000 owing to P. Okay, so you can see that the subsidiary had sold, he had bought goods from P on credit, and the receivable of 8,000 is recognized in P's records, in the parent's records. Okay, and in S records there is a payable. Okay, so how do we deal with this? You have to calculate the total receivables and payables to be shown on the consolidated statement of financial position as at 31st December 2010. Let us do that one very quickly. Okay, as you can see there, we are showing the extracts of the consolidated statement of financial position. Okay, the computations are, we just have to check all the receivables as per on a line by line basis. Payables, we do the same. Okay, so that's 50,000 for the parent plus 30,000 for S. Okay, but we have to deduct the receivables because I mean the we have to deduct the receivable because it was a receivable related to a sister company or to a subsidiary. Okay, so we need to deduct that one, and the corrected receivable would be 72,000. Similarly, we need to also deduct the payable, okay, of the subsidiary from the total payables. Remember, this one is for the parent, this one is for the subsidiary, so we have to deduct the payable, the corresponding payable. All right, so those are the figures. In a multiple choice scenario, please make sure you pick the correct figures. Otherwise, if you pick one correct figure and then a wrong figure on the and then an accompanying wrong figure, you are going to be penalized. Remember, in a computer-based environment, exam context, you are likely to fail if you pick one of the items incorrectly. Okay, now what about this example? It's a bit big, but it's very important for us to understand as part of our learning. So please just read through the example on your own so that we proceed. Okay, Pico acquired all the shares in Esco, so all the shares were acquired. Okay, so don't worry about the NCI. A year ago, when the retained earnings of Esco stood at $10,000, draft statements of financial position for each company as follows. So this information up to here is for Pico, and the other side is for Esco. Okay. Uh, During the year, Esco sold goods to Pico for 50,000. The profit to Esco being 20% of selling price. So this is 20% of this figure. At the period end, 25% of these goods remained unsold in the inventory of Pico. At the same date, Pico owed Esco 12,000 for the goods bought, and this debt is included in the trade payables of Pico and the trade receivables of Esco. So you just have to stand on your principle for you to understand this. Okay, the current accounts are cancelled; they are contracts. They cancel one another, but the inventory, which is still in stock, should only be reduced by the unrealized profit. Okay, and the impact of the unrealized profit is to reduce retained earnings and NCI if the goods were sold by the subsidiary to the parent. But if it was the parent which had sold the goods to the subsidiary, then in that case, only the retained earnings were going to be affected, but not the NCI. Please get this right. Okay, so let's do this question and see. So you can see that in the exam there is no time actually to do the group structure, the net assets on their own, and then you move on to the goodwill. You can simply do those things in the same computation. Okay, so let's go straight to goodwill computation. So let's start by calculating goodwill as our working number one. Okay, we start with the fair value of consideration. Fair value of consideration transferred. How much was it? From the question, you can see that the consideration transferred was 46,000. Okay, and the NCI, is not here because this, in this particular subsidiary, we acquired everything. So it's 100% on subsidiary. So don't worry about the NCI. So it goes straight to less net assets. Okay, net identifiable assets at acquisition. Okay, at acquisition, we have to consider the share capital, the retained earnings at acquisition. Okay, and we are told the retained earnings to the $10,000. Okay, and we can easily assume, or we have to assume that there were no changes to the share capital of the subsidiary. So 30,000 was for the subsidiary, and the retained earnings were stood at 10,000 according to the question. Okay, so obviously we have got 40,000 as net assets. Okay, we deduct these ones from the consideration transferred of 46, and we get a goodwill of 6,000. Okay, we can as well, squeeze working number 2 here for the provision for unrealized profit. Provision for unrealized profit. This is for inventory. For inventory that was still in stock at the reporting date, which involves transactions between um, intra-group companies. Okay, and we are told that there were sales of goods. Okay, during the year, Esco sold goods to Pico worth 50,000 at the profit of 20% of the selling price. So in this case, the goods were sold for 50,000. So that was the selling price, 50,000. So 50,000 multiplied by 20%, that's the profit element. So the profit element, profit is equal to 20% multiplied by 50,000. Okay, all right, multiplied by the inventory that we still have. Okay, and we are told that 25% of the inventory was still in stock. So multiplied by the inventory we have, which was 25% of the goods. So multiplied by 25%. Okay, and we get 2.5. So 2,500 is the unrealized profit. This should be reduced, deducted from the inventory. Okay, then let's compute the retained earnings. Working number 3, retained earnings. Okay, we have got the retained earnings of the parent. Okay, retained earnings of parent at reporting date. Uh, the retained earnings of the parent at reporting date was 45,000. Okay, now uh, you will discover that because we didn't do working number 2 for the net asset. Okay, for the net asset, we we would tend, we tend to face some challenges. Okay, because we need information for the retained earnings post acquisition, and we can as well do such computation within our our calculation, as you can see here. Okay, so you can say group share, group share of sub subsidiaries post acquisition retained earnings. We understand that uh, the the post acquisition computation is a bit complex because it is now involving other issues to do with provision for unrealized profits and so forth. So we know, according to the working number 2, the the subsidiaries retained earnings at reporting date according to the question, at reporting date, the subsidiary is having 22,000 as retained earnings. Okay, 22,000. This is at reporting. Okay, we have to deduct the retained earnings as acquisition of the subsidiary, and according to the question, we are told that they were $10,000. We have to remove this pre-acquisition retained earnings. Okay, then we also have to deduct the provision for unrealized profit. Okay, because those ones have to be reduced, have to be removed from our retained earnings. Okay, all right, and this is the amount which we have to have. Okay, so this means we have to recognize 9,500. All right, and the total retained earnings we are going to have is 54,500. Okay, but I want to highlight that this unrealized profit, okay, this unrealized profit, I mean, could have been reduced if the subsidiary was partially owned. If we were not owning 100%, it was going to be reduced by the parent share. Okay. Similarly, here we would have adjusted this difference here by the parent share. So obviously, all these figures in the background have been multiplied by 100%. The group's share in this regard is 100%. Okay, but if it was a 90% subsidiary or 80% subsidiary, would have multiplied by the 80% to signify the group's share. I'm sure we are together there. Okay, so don't worry about this share. The 100% is just one, not going to change anything. Okay, now let us now finish the group statement of financial position to see if we are doing things right. Okay, so group SFP as at 31st December 20 x0. This is 20 x 10. 20, according to the question, this should be okay, the question is silent about the date. Don't worry. Okay, just assume 20 x0. All right. So we start with the assets as usual. The assets, we have got our non-current assets. One. Okay. Non-current assets of the question, which were tangibles. We've got tangible current assets. Okay, and this we need to add them line by line. We had 80,000 plus 40,000. Plus 120,000. Then we have to consider the intangible goodwill, which is working number one in this case. working number 1, and we determine that the goodwill was 6,000. Okay, we make use of 1.6,000. Then current assets. Our current assets, ladies and gentlemen, we've got trade receivables. Okay, that's 30,000 plus 25,000. Then inventories, that's 10,000 plus 5,000. So let's start with the trade receivable. Trade receivable. That's we are talking of 30,000 plus 25,000. Okay, remember you do not have to close your brackets in this case because we have got some current account receivables and payables within the group. So we need to take care of that inventory. Inventories, okay. For inventories, we have got 10 plus 5. 10,000 plus 5,000. Again, because we've got the provision for unrealized profit, then we have to lessen the inventories with that figure, and we determine that this one was 2,500 according to our working number 2. Okay, and then here now, we are told in the question that there was a 12,000 that was here, the 12,000, which was appearing in both the receivables and the payables. So the receivables are going to be reduced by that figure and the payables by that figure. So we come here and say less 12,000. So what is the figure there? That's 43,000. Here we've got 12,500. Let's check with your calculators, and you get 55,500. Add up, and we should get 181,500. These are total assets which the group has. Okay, and then we have to do the other side of the statement of financial position. This space, we have the space, since my space short supply. Let me see what I can do for there. For the other space, okay, the equities and liabilities. Equity and liability side. Okay, our equity is in the form of ordinary share capital. Ordinary shares, $1 each. Ordinary shares of $1 each. Okay, ordinary shares of $1 each. We just take those ones for the parent, and from our question, you can see that this was 100,000. Okay, then we will have 2 columns. All right, and then we have the retained earnings. No share premium. What about retained earnings? That's working number 3 in this case, and we found how much in terms of the retained earnings. That was 54,500. Okay, add up, that's 154,500. Okay, 154,500. Then we have to because there is no NCI, this is a 100% owned subsidiary. We move on as quickly as possible to the current liability. Okay, these are in the form of trade payable. And we do our line by line consolidation. The trade payables which we have are 21,000 plus 18,000. 21 plus 18. But minus the other current account of 4,000. Okay, and we must get our 27,000. Add them up, we must get our 181,500. Sorry there, 500. So, as you can see, the balance sheet has balanced the assets are 181,500, which are the same as 181,500 for the equities and liabilities. Okay, so it means we've done our job correctly there. Okay, but you just have to be careful with the working when it comes to the computation of the unrealized profit. Okay, remember, if it is given in the form of markup, markup is just a profit. I mean, it's just profit as a percentage of cost. Whereas if you are given the gross margin, you have to know that gross margin is the profit as a percentage of sales. Okay, but this one was not a bit tricky in that regard because the examiner had clearly said that the profit was 20% of the selling price. Okay, but if he had used some of these words, that you just have to know that margin is the profit as a percentage of sales, whereas markup is profit as a percentage of cost. Okay, let's move on. Maybe probably on the way we might get across such technicalities. Okay, now we need to consider the impact of this intra-group trading on the NCI. All right, when subsidiary company which is not wholly owned is involved in intra-group trading within the group, a further problem occurs. For example, PICO owns 75% of the equity of ESCO. ESCO sells goods to PICO for 20,000, that is 15,000 plus 4,000 profit. If these items are sold at the period end, then there will be unrealized profit of 4,000, something like that. Okay, and these ones, we've done that one, we've covered just some repetition. Let me just take you to the other issues. Okay, but just as an emphasis, you just have to know, as I've indicated on this part, okay, that here in this part, I indicated that I mean, we were lucky because this problem was 100% subsidiary, but here, you know, the proportions should have applied. If it was a 90% subsidiary, we should have adjusted the figures with 90% and so forth. So this is the same point that even to the NCI, because the subsidiary is sold to the parent, so therefore the NCI are going to be affected. So the NCI profit or the NCI share is going to be reduced. Okay, so the NCI is going to be reduced with that proportionate retained earning. I mean, the proportion of the unrealized profit is going to reduce the NCI. So this is why we debit NCI and debit as well the group retained earnings. Okay, and then we have to reduce the inventory value, okay, with the total unrealized profit. Right, and this is a very important and interesting point. Note that the adjustment to NCI only occurs when the sale is from the subsidiary. So if it is a sale of subsidiary to parent, okay, sale by subsidiary to parent. If it is the other way around, then the retained earnings are only the group retained earnings are only the ones to be affected, but not the NCI. Okay, please take note of that. Okay, let's do example Harold and see if we can uh, make something meaningful out of the presentation. Harold acquired 90% of the equity shares of uh, of Cedar on 1 January 2002 when the retained earnings of Cedar were 5,000. Statements of financial position at 31st December 2023 were followed. So we've got information for Harold, demarcated by this line, and Cedar. Okay, and what's the requirement? All right, this is the other section of the statement of financial position. Cedar sold goods to Harold at a transfer price of $18,000, including a markup of 50%. Okay, two-thirds of those goods remained inventory at the year end. The current account in H&S stood at 20,000 on that date. The Harold Group uses fair value method to value net controlling interest. The fair value of the net controlling interest at acquisition was 4,000. Calculate the unrealized profit adjustment required for the consolidated statement of financial position of Harold Group. Show the relevant correcting journal. Then prepare a consolidated statement of financial position for the Harold Group based on the preceding illustration as at 31st December 2023. So we need, after this, we need to come up with the statement of financial position for the group. Okay, so in that case, what we need to do is to just breathe and relax. Okay, we are told that this 18,000 included a markup of 50%. Okay, okay, I'm looking for a pen here. Fine, I found it. Okay, what we know is that markup is equal to um, profit as a percentage of cost. Okay, profit is a percentage of cost, and we are told that the figure 18,000, okay, the figure 18,000 was the sales price. Okay, so what we know is that okay, this 18,000, please allow me to write here, sales was 18,000, okay, and this signifies 150%. Okay, so this included the markup of 50%. Okay, then what was the cost of the sales? Cost of sales obviously should be 100% for the statement to be true. For this statement to be true, the cost of sales should be 100 for the markup for the sales, which include the markup, to be 150, because we are saying markup is the percentage, is the profit as a percentage of cost. Okay, profit as a percentage of cost. All right. So obviously the cost should be 100 if the markup is 50%. So if we are looking at the sales, which include the markup, we are looking at the 100% of cost plus the percentage markup of 50. So 150%. So what is the profit? The profit is 50%. Okay, the profit is 50%. Now, gross profit. The gross profit is 50%. But how do we get this 50% in monetary terms? Okay, now here if you multiply 50% multiplied by 18,000, you would have done wrong. Okay, you would have done wrong. The markup has just given you the idea. Okay, the markup has given you the idea. All right, but it's not a percentage of sales. Okay, the markup is not a percentage of it is not profit as a percentage of sales, but it is profit as a percentage of cost of sales. All right, so let's determine the cost of sales. The cost of sales, we saw that it is 100%. All right, so for the cost of sales, we can easily say 100 over 150 multiplied by 18,000, and this should give us let me consult my calculator here. 100 over 150 multiplied by 18,000, 12,000. Okay, so this one is 12,000. So obviously 18,000 minus 12,000, we get a profit of 6,000. Okay, or you could have simply done this. Okay, you could have simply say 50 over 150 multiplied by 18,000, and you should have gotten your 6,000. Should have got 6,000. Okay, so that's the trick. The ordinary definition of markup and margin should help you to come up with these arrangements. Okay, in terms of the percentage, you see the layout of the percentages as I have done here. Okay, because we know that the sales of 18,000 include the markup. Okay, and the markup percentage is 50%. Okay, the markup percentage is 50%. So therefore, the sales are 150. Why? Because they include the cost of sales, which is 100%, plus the markup of 50, and you come to 150%. Okay. Now that when you know that arrangement or that relationship, you then have to say, now the gross profit in terms of money, in money terms, should actually be the 50% over the 150. Okay, 50% over 150, and you get your 6,000. Okay, or if you are still confused in that area, you can just go step by step to determine the cost of sales we know that the cost of sales should be 100% according to the markup definition. Okay, markup is equal to profit as a percentage of cost. Okay, so what is this cost? This cost is 100%. Okay, cost is 100%, but the sales is 150. So 100 of 150 multiplied by the sales figure, we get our cost of sales, and that's how we got the 12,000. All right. Now, if we deduct the 12,000 from the 18,000, we get our gross profit of 6,000. Okay. Now, what do we have to do then with that figure? The provision for unrealized profit is, I mean, must then be um, deducted. Okay, must then be deducted from the inventory. Okay, remember this is the total. The 6,000 is the total unrealized profit that has been gained. Okay, as a result of this transaction. However, some of the goods could have been sold outside. So if the goods has been sold outside the organization, then the profit becomes realized. Okay, but other goods could have been still in inventory. So those ones, for those items which are still in inventory, the provision for realized profit should be deducted. So we are told that 2/3 of the goods still remain in inventory. So that's 2 multiplied by, so that's that's 2 over 3 multiplied by 6,000, and we should get 4,000. So the 4,000 item should be removed from our records. They should be removed from the inventory. Okay, but we need also to consider the impact. Okay, they have to be removed from the inventory. Yes. Okay, that one is the credit inventory. Credit inventory with how much? 4,000. But we have to debit retained earnings of the group with how much? If it is a 90% subsidiary, then we say 90% multiplied by 4,000. And we are going to debit 3,600 retained earnings. So we are going to reduce retained earnings by 3,600, and then NCI with the remainder, that is 10% of 4,000, that is 400. So we are also going to debit NCI 400 to make sure that it adds up to 4,000, and that's how you do your bookkeeping. Okay, so basically this is what is being shown here. Okay, this is the 90% subsidiary. There's the group trade earnings would be have to be 3,600 debit. We have to debit the group retained earnings. By debiting, we are reducing the retained earnings. Okay, and then here the NCI is going to be reduced again by 10%. So we debit here, and then we credit group inventory 4,000, the overall total. Okay, because we were to reduce the inventory with the unrealized profit. Now, what about the overall statement of financial position? Okay, statement of financial position should be okay. All right. This should be the statement of financial position, where we are simply saying, if we start with our group structure, as you can see there, this is a 90% subsidiary. All right, and okay. Now, as you can see, that's a 90% subsidiary. Okay, and you can also see that when it was acquired, the retained earnings to 5,000. Okay, we covered that. So the workings are as explicitly as you can see there. Okay, so the net assets, the share capital, okay, was 5,000, and still remain at 5,000, and then the retained earnings, as we have already seen there, at acquisition they were 5,000, but at reporting, the reporting figures for retained earnings, please allow me to just erase these ones. Okay, you can just replay the video if you want those figures. All right. So as you can see, the retained earnings of the subsidiary are now set one at reporting. So in our, this is why you are seeing in our net asset computation that the retained earnings are set 1,000 there. Okay, and then we consider the provision for unrealized profit, okay, for the subsidiary, which was 4,000. All right, but remember we needed to adjust this one. Remember the 4,000 included everything. I mean, both for the NCI and the parent. Okay, so when we do the computation for the NCI and the parent, we need to apportion. So in our computation for the goodwill, okay, the fair value consideration, that was 34,000, and we now know how to calculate to determine this figure, okay, 34,000. And then the fair value of NCI at acquisition is also given in the question at the date of acquisition. Okay, the NCI at the date of acquisition was 4,000. So you can see that, and you get your NCI there. Okay, and then you have to deduct the net assets as we have determined there. This is why we are deducting the 10,000 there. Okay, and then you get your goodwill at acquisition. Then you proceed to the working number 4, okay, where we say that the NCI, you start with the fair value of NCI at acquisition, which is found in working number 3. So which means these figures should actually be the same, as I've already indicated in the initial part of this video. And then we have to adjust the share of post acquisition reserve. Okay, the post acquisition reserve has to be adjusted. All right, we have to adjust this movement. Okay, now I'm sure you're appreciating that the movement in working number 2 was actually facilitated by the retained earnings and the provision for unrealized profit. Okay, so if you add them up, okay, here if we add everything up, we can see that the net assets at acquisition were 10,000, but they ended up becoming 32 if we put everything there into effect. Remember, the PURP has a tendency of reducing because it is not part of the group profit, so we reduce that. Okay, so you can see that there was a movement from 10 to 32, which is a $22,000 movement. So we have to adjust with the NCI percentage. Remember, we acquired 90% of the shares, therefore the NCI is for the 10%, the remaining 10%. So this is why we do that computation, and we ended up having the 2.2. So if we add 4.0 plus 2.2, we get our 6.2, which is the value for the NCI in the statement of financial position. Then we do the group retained earnings 100% retained earnings of the parent at reporting date. This is 159. You can cross check from the question 159, as you can see there. And then we have to multiply. So you see this process should also be supported by this process. Okay, and you get the 19.8, and the retained earnings are 178.8. Okay, once you do these workings, you then have to okay, this is for the PURP. Okay, the PURP, our sales were 18,000, therefore they represent the 150%. Then the cost of sales 100, therefore gross profit should be 6. If you say 50 or 50 over 150 multiplied by 18, you get your 6. Then you have to adjust because 2/3 of the items are still in inventory, so therefore 2/3 multiplied by 2, so it must be 2 over 3. 2/3 multiplied by 50 over 150 multiplied by 18,000. You must get your 4,000. Okay, so for working there. Now, for the statement of financial position, so we start with our goodwill. Okay, the goodwill is computed in working number 3 here. We obtained 28,000, which is the amount. Then property, plant and equipment, line by line, that's 100 plus 30. Um, is that's 100 plus 30. Okay, this is why we have that amount there of 130. Then the inventory value is going to be reduced by the provision for unrealized profit of 4,490 plus spend of the subsidiary minus 4,000. You get that one. Receivables, we're going to reduce with the intra-group. This intra-group deduction here is also going to affect the liabilities here. So you can't do the intra adjustment here for the current account without also settling for that one. So auditors usually look for those errors and question directors where they will be found wanting. So that's what happens. And then the other items just have to add costs. That's what happens. Then the equities do the same. NCI is what we have done on working number 4 here, the 6.2. You can see the 6.2 here. Everything is line by line, and Shula, we have done it. Okay, now about acquisitions mid-year, you need not to worry much because it's not a trick situation. If a parent entity acquires a subsidiary mid-year, the net assets must be calculated at the date of acquisition. The net assets at acquisition can be calculated as the net assets at the start of the subsidiary financial year plus the retained earnings for part of the year up to the date of acquisition, together with any fair value adjustment at the date of acquisition. To calculate this, it is normally assumed that as profit after tax has occurred evenly throughout the year. Okay, that's the assumption that is usually made. Okay, so there is this example called for us to give a try. Then we continue together. You can just pause the video and try on your own. Okay, let me see. Those are the requirements. Okay, you have calculated the retained earnings of Cardi, the Code Group, as at 30 November 27. You need to prepare the consolidated statement of income position of Cardi based upon the information as we have been given them. Okay, so let's give it a try. Okay, Core Decay acquired 60% of Solace on 1 May 2027, paying 76,000 cash. The summarized statement of financial position of the two entities at 30 September, at 30 November 2027 were non-current assets, property, plant, and equipment. Obviously, this should be okay. This should be our consideration transferred. All right, when we are acquiring the S subsidiary inventory, that one. Then the information of interest. At 6 November 2027, the inventory of S included goods purchased at a cost of 8,000 from K, so from the parent, at a cost of 25%. None of the goods had been sold on by S by the reporting date. The K group values the non-controlling interest using the fair value method. At the date of acquisition, the fair value of the 40% non-controlling interest was 50,000. S earned a profit after tax of, for the year of 9,000 in the year ended 30 November 2027. So we are required to prepare the statement of financial position for the group. All right. Remember, in this case, the intra-group sales were from parent to sub. In this case, the NCI is not affected. The NCI is not affected. They want their money as it is. Do not have to deduct any provision for unrealized profit. Okay, so let's start with our first working. Okay, we can start with working number 1. This could be for net assets. Okay, you could have even talked of okay, the group structure, but I let us call it working number 1, group structure, so that we don't confuse others. Okay, group structure, we have got K. Alright, K acquired S 50%. Okay, therefore NCI is equal to 4%. Okay, deal. Then we have to move on. This should be our working number 2. Okay, working number 2, we've got net assets at acquisition at report. Okay, dollar sign, for the share capital. The share capital at acquisition. The share capital could be assumed to be the same there, but the retained earnings at acquisition, can we get that information? Um, okay, we are only told the information that during the year, S earned a profit of 9,000, okay, and a profit of 9,000, okay, the net profit. All right, so we are also told that this subsidiary was bought uh, during the year on 1 May. Okay, so this is a mid-year acquisition problem. Okay, so we need to make some inferences. We need to assume that the profit was evenly distributed throughout the whole year. Okay, so from 1 May to 30th November, because the year end is November. Okay, the year end is November. So 1 May to November, that's May, June, July, August, September, October, November. So that's 7 months. So For 7 months, they made a profit of how much? For 7 months, okay, they made a profit of 9,000. I mean, for the whole year, right? For the whole year, right? They made a profit of uh, for the whole year. For the whole year to 30 November, they made a profit of 9,000. So, which means for 12 months, all right, they made a profit of 9,000. So, in 7 months, how much did they make? So that's 7 over 12 multiplied by 9,000. They should have made uh, a profit of 5,200. But we know that their retained earnings at the reporting date was 59,000. Okay, was 59,000. So what is their profit at acquisition? The subsidiary was bought on 1 May, okay, but they made profit for the 12 months 9,000. So in 7 months from 1 May from 1 May to 30 November, they made 5,200, assuming the profits were evenly distributed. So therefore, their retained earnings at acquisition should be 59,000 minus 5,200, and we should get uh, the the retained earnings at acquisition of let's say 3,750. That should be our retained earnings at acquisition. So we should come here and say retained earnings at acquisition should be 69,000, okay, minus 7 over 12 multiplied by uh, multiplied by uh, the profit. How much was it? The end 9,000. Okay, so multiply by 9,000. And this should actually be with the 3,000. How much? It's 3,750. Okay, which is given by 69,000 minus in bracket 7 over 12 multiplied by 9,000, close bracket and close another bracket, and we get your 63,750 as the retained earnings at acquisition. And then at reporting, we know it was 69,000 from the question. Okay, then we then have to add up. These are the mathematics that are involved in these consolidations. You just have to be watch. You just have to watch out. So here that's 103,750, and there is 109. All right, let us now do the calculation for. We need the working for. We need working. Get working for our goodwill. Working number 3. Working number 3. goodwill. Okay, fair value of consideration. Fair value of consideration. From the question, the consideration can be seen. That's 98,000. Okay, that's our consideration, ladies and gentlemen. Okay, okay. Um, this question is a bit tricky, and you need to just ensure that you practice. Okay, but you need just to show the examiners that you were paying attention to all the lectures attended. Okay, the question is well requires your comprehension at the high possible level. Okay, as you can see, our first uh, sentence to the scenario is saying that the code acquired 60%. Okay, acquired 60% of this subsidiary by paying 76,000 cash. Okay, and the 76,000 is obviously the consideration transferred. So in that case, it is dangerous to just pick 98,000 and say that was the consideration, because we are not told about anything about the investments there, but what we are told explicitly is the 76,000 was paid. So instead of picking the 98,000, we have to pick the 76,000 as our consideration transferred. Please watch out for those tricks. Remember, these are rich examples. Okay, and then the fair value of NCI. This one was given directly to us in the question. We are told that this was 50,000, so we just have to slot in the 50,000 fair value of NCI at acquisition. Okay, and this was 50,000. Okay, and we get 126,000 there. Then we have to deduct less net assets. Net assets at acquisition. The net assets at acquisition are these ones. So that's 103,750. Okay, my 50 not clear there, but I hope you are seeing it. I mean, you are following me. So our goodwill should be from me use my calculator. That's 22,750. That's the goodwill. Okay, and working from the question. Okay, let's now deal with the issues to do with the provision for unrealized profit and the NCI. Okay, sometimes you can just say, you can put your working number 4 and working number 5. Number 4 is for the NCI. Number 5 is for your retained earnings. Okay, you can just put some placeholders so that you just do another working that might be simple for you. Okay, working number 6, the PURP. Okay, the issues to do with PURP. Okay, this is the profits in inventory. I mean, the provision for unrealized profit in inventory. Profit in inventory. Okay, we are told that in the question, at 30 November 27, the inventory of S included some goods purchased at a cost of $8,000 from K at a cost of at a cost plus 25%. None of the goods had been sold on by S. Okay, so these goods were sold at cost plus 25%, so there was a markup of 25%. Okay, so we just do the same trick as we did before, okay, if you still remember. So in this case, we are going to simply say cost plus 25%, so that's 25 over 125, all right, multiply by the um, items, okay. So we go to S and we ask ourselves, um, okay, the cost was 8,000, all right. So I mean, the purchase price was 8,000, okay, but this price included a markup of 25%. All right, so that's, and we are told that all had not been sold, so no need to adjust for any percentage of the items remaining. Everything was still in inventory. Okay, so that's the amount which we require, which is 1,600. Okay, that's the profit element. Now we need to adjust this to know if it is going to affect the NCI or not. But as this was sold by the parent, therefore the NCI is not going to be affected. So only the retained earnings of the group are going to be affected. So for the NCI, we just do the ordinary, that's fair value of NCI at acquisition, which is given in the question, and the question had told us that this was 50,000. Remember, it is also equivalent to the NCI which we put on working number 3, okay? And then we have to add the fair value, or I mean the share, NCI share of post acquisition reserves. Okay, this could be retained earnings, revaluations, so many such items. Okay, so to say reserves is actually a bit, precautionary. So in this case, if we go to our working on net assets, we could see that uh, we were only talking of the retained earnings, okay, the influence of retained earnings, the changes there when it comes to retained earnings there, okay, because the subsidiary did not sell anything to the parent, so this is why the PURP was not included on the net assets movement. So we are talking of the difference that is between the retained earnings, okay. So that should be how much? 63750 minus that one. We are talking of how much there. Let me punch this calculator of mine. Okay, you can as well just use this, or these figures. They are going to give us the same answer. Okay, they're going to give us the same answer. So that's, we want to say 103,750 minus 109. Remember, this is a 10% subsidiary. Let me just cross check. No, the 40% subsidiary. So we are going to say 40% multiplied by the difference 109,000 minus 103,750. Okay, and we have to get 2,100. So this is 2,100. Okay, then we have to total up and we rest at 52,100. 52,100. Okay, we move on to the retained earnings of the group. We start with the parents on. The parents on, we just take the retained earnings, 100% retained earnings of the group, of the parent at reporting date, and we can see that this is 189,000. 189,000. Okay, we then have to worry about the PURP, which is working number 6, and working number 6 we determine that it was 1,600. Okay, and then group's share, the group's share of subsidiary post acquisition, retained earnings or reserves. In this case, this is 60% multiplied by this difference, multiplied by 109,000 minus 103,750. Okay, then we must get our 3150. So if we add up, we must get our 190,550. Okay, I guess that's clear. Then we have to then draw up our statement of financial position for the whole group, and that shouldn't be difficult. So let me try the better pen. So Group SFP as at 3rd November 20x7. Okay, so we start with the assets. Okay, assets of the group, but non-current assets, and start with the tangibles, the PPE. Okay, the PPE, these ones we've got 138 plus 115. 138,000 plus 115,000, and we get our total 25300. And then we have got Goodwill, which is our working number 3, and we obtained this amount, as you can see here, the 22,750. Okay, add up, we should get 297,250. Go to the current assets. We start with the inventory. Okay, but we need to adjust the provision for unrealized profit. So we take our inventory values from the balance sheet. That's 15,000 plus 17,000. Minus 1,600, which is the PEP working number 6, and we must rest at 30,400. You go to your receivables. Our receivables, we've got 19,000 plus 20,000, minus any current account that is in existence. Are we told of any current account from the question? There were no current accounts. So, this case, we just have to close our bracket. No need for further adjustment. So that's 39,000. Okay. Then we need to ask ourselves: are there still other current assets not considered? Yes, we have got cash. That is 2,000 plus 0. Cash 2,000 plus 0, that's 2,000. Okay, then let us add up all these figures from this one to this one, this one to that one, and we must get the total asset of 368,650. That's the asset side. Now let's move on to the equity side. We have got equity and liability. Okay, we say the equities. We start with the equity elements: equity, share capital, share capital, equity share capital. This is for the parent. You just have to pick for the parent only. Okay, you pick for the parent. That's 50,000. Okay, and then from there you go to the retained earnings for the group, as we did on working number 5. That was 190,550. Okay, and we go to NCI, that is working number 4, not 3. NCI, that is 52,100. Okay, we add them up and we must get our 292. Okay, 650. Then we go to the liabilities and we only had current liabilities, and we just do a line by line item, consolidation. So the current liabilities were 33,000 plus 43,000. That's 3,000 plus 43. and we get 76,000. And just cross check. Yes, 33. So if you add them up, you just have to arrive at 368,650. So you can see that we have got the total equities and liabilities of 368,650 and total assets of the same figure. Then our balance sheet has balanced. Okay. I hope, ladies and gentlemen, we have done justice to our lecture, and sometimes the net assets would be adjusted. The net assets, okay, sometimes there might be some need for fair value adjustment. I think we just have to talk about that, and then we talk of the equity accounting, and we rest our case. I'm sorry the video has been long. I wanted to make sure that everyone is actually helped and nobody should be left behind. So I'm sorry for that, but the video is going to be helpful to you if you are studying. If you are still in the initial stages of financial accounting, just have to enjoy this consolidation. Okay, so let's go straight to the fair value issues. Okay, basically, when we are talking of fair value, we are simply referring to uh, the price, okay, some price or the price that would be received to sell an asset, okay, the price that would be received to sell an asset or paid to uh, transfer a liability, okay, the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Okay, this is in accordance with IFRS 13. Okay, IFRS 13. I can refer to paragraph 9. All right. So sometimes when the acquisition has been done, you may discover that certain fair value measurements would not be available, and there would be need for some adjustments when those when information concerning certain items come on board, okay, or is revealed. So let's just go through this example together to see how these fair value adjustments are going to be made for the purposes of consolidation. All right. Hasselnut acquired 80% of the share capital of Peppermint on 1 January 2023 for cash consideration of 1 million. At the date of acquisition, P had retained earnings of 125,000 and a revaluation surplus of 100,000. At acquisition, the fair value of P's plant exceeded its carrying amount by 200,000. At the date of acquisition, the fair value of 20% non-controlling interest in P was 380,000. So that's the statement of financial position. Those are the statements of financial position of H and P as at 31st December 2024. Okay, that's at the reporting date. So we need to calculate the fair value of net assets of P at the date of acquisition and at the reporting date. Okay, so let us do it. Now, this is just working number 2 in general, okay, for the net assets. Because these fair value issues might come up and you mustn't be found wanting. So as usual, we've got at acquisition as well as at reporting. So we start with the share capital. Okay, this one is not expected to change. This one is usually not expected to change. So we are having the share capital for the subsidiary is 400. So you just have to slot in the figure. Okay, remember these figures are in thousands. Okay, then we just have to follow these. Okay, that's how you get. That's where you get your information for the net assets. Okay, so the share capital, the revaluation surplus, the retained earnings. Okay, you just have to slot them there. So retained earnings. Now we start with the revaluation. Sorry. Revaluation surplus. Okay, we are told in the question the revaluation surplus at reporting was 100 but 300 given. You can see here 100, the retained earnings are 300. So just have to slot at reporting, just have to take those figures where at reporting that's 100 and 300. So come here, say your 100, the retained earnings of 300. Okay, my 3 is too small. Okay, what about at acquisition now? At acquisition, we go back to the question. I'm sure we are told somewhere. At the date of acquisition, P had retained earnings of 125 and revaluation surplus of 100. So we slot in those figures, 100 for the revaluation and 125 for the retained earnings. Okay, then we are also told about this other paragraph. At acquisition, the fair value of P's plant exceeded its carrying amount by 200,000. So the PPE, okay, the PPE fair value uplift was 200. Okay, so we need also to consider the 200 there. Okay, and okay, the other information for the non-controlling interest. All right, so this is how we get our fair values. So we need to add up and we get our 825 and 1000. Sometimes after we do this, we are told that the depreciation policy could be, let's say, these PPE are to be having a shelf life or a useful life of, let's say, 3 years. Then we need to adjust with the depreciation, and the depreciation is not going to affect the acquisition. The acquisition values, but will affect the post-acquisition value. So let's say in this case, this PPE was expected from the date of acquisition to be useful for the next 4 years. So we are going to say extra depreciation. The extra depreciation It's not going to affect at the acquisition, no, but at the post acquisition. So the extra depreciation will be 200 over the the useful life of 4 years. So in this particular year, we are going to charge 50,000, which is going to be a negative figure, and this will reduce our 1,000 to become 950. Okay, and that charge is also going to affect our retained earnings and so forth. Okay, that's a bit of what we need to know. Okay, then let's talk of equity accounting. Okay, let's talk of equity accounting. When we end up having some associates within our group. And what is an associate, by the way? An associate is defined as an entity over which the investor has significant influence. That is in terms of International Accounting Standard number 28, paragraph 3. Please note that joint ventures are not part of the syllabus, okay, of the syllabus of the FA, the Acca FA. They are not part of the Acca FA paper syllabus, okay? What do we mean by significant influence? This is the power to participate in the financial and operating policy decisions of the investee, but is not control or joint control over those policies. An investor is an entity which owns a shareholding in another entity. An investee is an entity in which another entity has a shareholding. An investor is presumed to have significant influence over another entity when it has shareholding in that other entity between 20% and 50%. Okay, that's the basics. So for us to account for these associates or investment associates, we need to do what is called equity accounting. This is a method of accounting whereby the investment is initially recorded at cost and adjusted thereafter for the post-acquisition change in the investor's share of net assets of the associate. The effect of this is that the consolidated statement of financial position includes 100% of the assets and liabilities of the parent and subsidiary entity on a line-by-line basis. A single investment in associates line within non-current assets, which include the group share of the assets and liabilities of any associate. The consolidated statement of profit or loss includes 100% of the income and expense of the parent and subsidiary entity on a line-by-line basis. A single share of profit of associates line, which include the group share of any associate's profit after tax. Note that in order to equity account, the parent entity must already be producing consolidated financial statements. So, in order to equity account, the parent entity must already be producing consolidated financial statements. That is, it must already have at least one subsidiary. Okay? Otherwise, there is no need to do the equity accounting. Okay? That's the idea. Okay? The entity should be having a subsidiary. Okay? The entity should be having a subsidiary. Okay? So basically what we are saying here is that the requirement for us to produce consolidated financial statements is only due to the need that we need first to have control. Okay, so there should be a subsidiary for us to prepare consolidated financial statements. Otherwise, we do not have to worry about consolidation if there is no subsidiary. Okay, so this simply means that, okay, equity accounting, when it is now being done, where there is no subsidiary, it would not be in a context of consolidation, okay? Because consolidation only happens when there is a subsidiary. All right, that's the idea there. Now, let's take a look at an example to see how we can do the computations required. Okay, that's the equity accounting template. All right, where we are saying that we have to have the investment at cost plus the share of post acquisition less any payment losses, okay, less any group share of PURP where the parent is the seller. If the parent sold goods to an associate, we then have to deduct the PURP, excuse me, the group share of the associate's post acquisition profits or losses, and any payment of the investment in the associate will also be included in the group retained earnings computation. So be careful about that. Okay, now we have got this example there. Pepco acquires 25,000 of the $1,001 ordinary shares in Acca for 60,000 on 1 January 28. In the year to 31st December 28, Acca earns profits after tax of 24,000, from which it pays a dividend of 6,000. How will Acca's results be accounted for in individual and consolidated accounts of Pepco for the year ended 31st December 20XI? Okay, now we should have to account, okay, for the dividend that has been received, okay. Acca earns profits of the tax of 24,000, from which it pays us for a 25% dividend of 6,000. Okay, so how do we record this dividend? Okay, in the parent, okay, in PEPs, let me look for a pen that is brighter. Okay, in PEP, statement of profit or loss, okay, we are going to have an entry for the dividend. Okay, we're going to debit. All right, the dividend received. All right, okay, so we have received cash of 25% multiplied by 6,000. Okay, and this should be 1,500, and we are going to credit, okay, dividend received is our income, dividend income, 1,500. So this is the option which we have, all right, but we can have the option which is I mean advocated for by International Accounting Standard number 27, okay, the equity method in separate financial statement amendment, which is an amendment to IS 27, effective 1 January 2016. All right, so effective 1 January 2016, we just have to do the um, equity accounting, okay, which is um, um, the most viable option available. All right, so the equity accounting. How do we do that? We then have to say, instead of just showing the dividend received, okay, the consolidated statement of profit or loss would include the group's share of uh, Edge's net profit for the year. All right, Edge's net profit for the year. Okay, so the group, uh, the group, it's the group's statement of profit or loss would have the group's share of Edge's net profit for the year. So we can simply say the group's share in the statement of profit or loss, okay, the group's share of Edge net profit for the year. In this case, we know that this Edge is a 25% associate, okay, all right, multiplied by the net profit. According to the question, the net profit after tax is 24,000. Okay, and we know that this is 6,000. All right, and this should appear uh, this should shown before the group profit before tax. Okay, it should be shown before the group's tax. Okay, the group's profit before tax. All right, although it is um, income after tax, we have to show it before the group's profit before tax. Okay. Um, Now, what about in the statement of financial position? Okay, in the Group SFP, um, the investment in associate, the investment in associate would be calculated as follows. Okay, we are going to have the cost of the investment. In this case, the investment was how much? 50,000. That was the cost of the investment. Okay, then share of Edge profit for the year. Edge profit for the year was how much? The share, we determined that the share of the 24,000 profit was the 25%, which is 6,000. So we're going to say 6,000. Okay, then less any dividend received. The dividend was 6,000 multiplied by 25%. Okay, it was 1,500. So the investment the investment in associates would be 54,500. That would be the investment in associates. Okay. Now, the other point to note when dealing with associates, sometimes we we do the trading between the associate and the parent. Okay, so generally the associate is considered to be outside the group, as the investor is only able to exercise significant influence rather than control. Therefore, any sales or purchases between the group entities, parent and subsidiaries, and the associate are not normally eliminated and will remain part of the consolidated figures in the statement of profit or loss. Instead, it is normal practice to adjust only the group share of any unrealized profit in inventory. So the PURP in inventory is the one that needs to be adjusted. The PURP in inventory, in unsold inventory, the normal adjustment we do, but not the issues to do with the current accounts, the payables and receivables. Don't worry about those ones. Okay. Then our objective was also to be able to define or to understand or to explain what a simple investment was. Okay, simple investment or a trade investment. Okay, this is when an entity invests in the shares of another entity but acquires neither control nor significant influence. So it's not an associate, it's not a subsidiary, it's something else. So that one is called a simple investment. In this case, the investment is carried as a non-current asset in the settlement of special position, and any dividends received from the investee are included in the settlement of profit or loss. Okay, remember we said that this one is accounted for under IFRS 9, the financial instrument, usually recorded at fair value at the end of every year. Okay, I think we discussed about that, and we are almost done, ladies and gentlemen. If you feel like you need further coaching, you want to become one of our students, just feel free, because we are there to help one another. Okay, I will always be there for you guys. So just feel free to get in touch with me on the numbers shown there on the screen. Okay, so that's how we do it, ladies and gentlemen. And I hope we are going to see each other. We're going to meet in the coming video, where we'll be targeting our attention to the statement of profit or loss, as well as the statement of cash flows. Okay, so please stay tuned for accounting, for professional accounting coaching with the number one tutor online. Okay, so don't forget to like the video, to click the notification bell, and to subscribe, so that we do the right thing. Okay, so these are my numbers. You can get in touch with me there. Okay, or let me just write them on the screen. To those, I mean, for those ones, we have got some vision impairments. Okay, talking of plus 263 774 596 368. Okay, those are my numbers. So anytime, ladies and gentlemen, when you feel like you want to talk to an Acca tutor, okay, or a finance tutor rather, please just feel free to get in touch with me. I'll always be there for you. For now, I am signing out. Thank you.